Okay. So sorry, went ahead without recording. So let me just real quick summarize what we're doing. We are looking at, we are completing chapter 18. We are going to look at firm valuation. And so what I'm talking about here is if you were going to sell a company, like a medical practice, for example, a physician's practice, if you were going to sell that physician's practice to, say, a hospital, how much would you be willing to take as the owners of the physician's practice? How much would the hospital be willing to pay you? So that's the question we're trying to address today. And so we're going to take a couple of different approaches to look at firm valuation, or deciding what is the price that someone would be willing to pay for a firm that is an ongoing business. So what I'm showing you right now is, so we're going to start by looking at asset-based valuation. Okay. So, and so what I'm showing you right now is the financial statements that were shared in the Catholic Medical Center 2016 annual report. Now, what you see in the annual report is not an audited financial statement. Instead, it's a very abbreviated version of what you would get in the actual financial statements. Now, these are the actual numbers. They're just at a very high level. They've been summarized a lot more than you would see if you had access to CMC's actual financial statements. Okay, so very briefly, they had $349 million in revenues. They had $342 million in operating expenses. So up 349 operating revenue, 342 operating expenses. That gives us their operating income of $7,025,000, because these are all in thousands. Then they had non-operating gains of $3,675,000 for a total excess of revenues over expenses of $10,700,000. Okay. And this, so they're not for profit. So they, instead of calling it net income or net profit, they call it excess of revenues, right? But that's, remember, that's the same thing. We've talked about this before. So that's just a quick review of what we're looking at here. And then down below is their balance sheet. So we have assets. So we have their cash. We have long-term investments, property, plant, and equipment, and then other assets. Total asset value of $343,301,000. And then the second half, right, typically the right half of the balance sheet is their liabilities and net assets. Remember, this is a not-for-profit, so we're going to say liabilities and net assets rather than liabilities and owner's equity. I'm going to bounce back and forth as usual between calling it net assets and owner's equity. So what do you have here? Again, very high level. So they don't have all the summary lines that I would normally stick in something like this, but they've got their current liabilities, long-term liabilities. They don't have a total liabilities, but you can just add those two together and get the total liabilities. Then they have the three different kinds of net assets, right, that add up to their total owner's equity. So you add these three up to get their total net assets or their equity, right? So liabilities plus equity gives us total liabilities and net assets, or total liabilities and owner's equity, and it's a balance sheet. So total liabilities and net assets has to equal total assets. Okay, so I wanted to show you that because I copied it over to the spreadsheet that I sent you by email, I don't know, about 40 minutes ago. So if you would, if you've got it handy and it's convenient, go ahead and pop that sheet open, because we'll do a couple of things here. So first thing you need to do is, I noticed after I sent it to you that I had a typo. I think I reversed it. I made it 149 instead of 419 or something like that. So the long-term investments number should be 99,419. So if you would check that and change it, I'm going to take that yellow off because it's otherwise not significant. I just realized there was an error. So total assets has to add up to total liabilities. And obviously I didn't check it closely enough. It had, you know, it transposed two numbers and it looked good until I started working with the numbers. They weren't adding up properly. So, all right, so we've got the, so I told you we're going to work on an asset-based valuation of a firm. So in this case, we're just going to play with CMC because we've talked about CMC a gazillion times. So if CMC was going to sell itself, and it is now kind of merged with Dartmouth, it didn't, or affiliated with Dartmouth. They don't want to call it a merger. They have affiliated with Dartmouth. It's really a merger. And have kind of merged their assets. But if they were going to sell themselves, say, to HCA, which is what Frisbee did, Frisbee, you would have a much more complex negotiation over how much is this firm worth, because Frisbee would actually be giving a certain amount of money to the community to pay for the hospital's, whatever the hospital's value is. So the first, kind of like the bottom line value of the firm is whatever its stuff is worth, right? So if you were to just look at the firm as a pile of stuff, right? So with CMC, that would be, that's the building, and then it's all the stuff inside the building. So all of the scanners and the OR tables and the, Da Vinci robots and all that stuff that's inside the building, right? So that's your, property, plant, and equipment. And then CMC's got a big fat bank account worth $114 million. It's got a whole bunch of long-term investments worth almost $100 million. It's got other assets of different shapes and sizes that we don't have the detail about, worth $35 million. So all the stuff that CMC has is worth $343 million and some change. So you could say, well, if you want to buy CMC, it's going to cost you $343 million. Well, the fact of the matter is, yes, that pile of stuff is worth $343 million. But in order to acquire CMC, you would have to pay off all the liabilities. So let's kind of go over here and say, all right, is that big enough for you guys? I can make it a little bigger. Assets, total assets is equal to this, right? So we're not really doing anything with that. Let's move this down. And then their liabilities are equal to that. And then their equity is equal to the sum of the net asset accounts, right? So if I wanted to buy CMC for whatever its asset value was, I'd have to pay $343 million, right? And so I would have to pay, if I was going to pay for the value of the firm, I'd pay $343 million, but $228 million of that would have to go to the various credit holders, right? So banks that have loaned them money, bondholders that have loaned them money. I'd have to pay the owners of CMC, which is kind of this, well, it's the church, the Diocese of Manchester, would not get $343 million. They would get $114 million, which is $343 million minus all the liabilities of $228. Okay, so the way what we talk about here is we say the book value of CMC is its assets minus its liabilities. Okay. So its book value is basically its equity value. And so this is kind of what the minimum value of the firm would be. Now that said, so if HCA, a for-profit entity, was to come in and say, hey, we'd like to buy CMC, um, how much are you willing to sell it for? Well, you'd sell it for maybe the 343 number. But if you were to sell it for the 343 number, you would have to include all these long-term investments. And then you would split the payment, whatever it was, the 343, between the 228 that goes to the debt holders and the 114 that goes to CMC. In reality, so like Frisbee, which was a not-for-profit, had some long-term investments too. Portsmouth Regional, when it sold itself to HCA, had some long-term investments. HCA is not interested in buying the long-term investments, right? They're not interested in that. So they're going to tend to pull the long-term investment value out of the purchase price. And they're going to say, hey, not-for-profit, let's transfer that 99 million out of the value, out of the balance sheet and into a foundation, right? So that is actually what happened with Portsmouth Regional, right? So they when they went to sell the Portsmouth Regional, they took out whatever long-term investments they had and they extracted that out, put it into a new not-for-profit entity. I forget the name of it. It's something like Seacoast Health Alliance or something like that. And what they're supposed to do is they take that money and they fund projects, give out grants to not-for-profits that are working with health, working to promote health in the Seacoast area. So if they did that, though, the equity would have to go down by the same amount that you pull out of the long-term asset. So if we were to subtract the 99 million in long-term investments from the total assets, you'd be left with 243 million in assets. You still have 228 million in liabilities, and so your equity would decrease, right, by that 99 million to 15,567. So if we were to do that again, the book value of CMC would really be 15 million. Now it's 15 million because we extracted 99 million out of it. Now you're saying, if you're paying attention here, you might be saying, well, what about the cash? I mean, there's a big wad of cash there. It's even bigger than the long-term investments. At any point you could extract out some of that money. Each time you do that, it reduces the book value that's going to go to the recipient of of whatever the equity value is at the end of the transaction. So if we were to leave the cash there but pull out the long-term investments, then let's say HCA was buying CMC for its book value. Let's say they agreed that that's what they would pay, and I'm not, and that's probably would not be the case, right? This is not how, typically book value is like the lowest possible value that you would assign a business. I think CMC's leadership would make an argument for something higher than that. We'll look at a different version here in a minute. So oftentimes what you see is they'll leave the cash in there because they could use the cash as part of the arrangement to pay down some of the liabilities. So if you were to do that, let's say they used all of the cash to pay off some of the liabilities, then the assets would decrease again by the amount of cash, but then the liabilities would decrease by the amount of cash. And what we now would have is we're back to our original value, right? So getting to that book value, basically, the more resources you take out of the organization, the lower the book value is going to be. For-profit entities typically don't have this, right? They typically don't hold large stocks of investments, right? So typically, you're not going to see this in a not-for-profit. So if we were to look at HCA, right, or if we were to look at even just a large physician practice that's a for-profit entity, they're not going to have they may have some long-term investments, but the amount will not be anywhere near what you're seeing here with CMC. Right, it'll be a relatively small number. So this is kind of unique to not-for-profit hospitals in particular, but not-for-profits in general, is to have this long-term investments line here and have it be significant. So that's why you might see when a not-for-profit goes to sell itself, a not-for-profit hospital goes to sell itself, they'll pull out the long-term investments. And then the cash just kind of becomes, the question becomes, does the purchasing entity want to take on the liabilities, or does it want to sell off, say, use the cash to pay the liabilities down? That's more complicated than we need to get into, but so if HCA was buying CMC, they might say, yeah, leave the cash, we'll use that to pay down the liabilities, or leave the cash and we'll just keep it, and we'll keep the liabilities in place. That doesn't really matter for our purposes. The main thing you need to know is the book value is kind of the bottom amount that it's kind of the minimum estimate of what the business is actually worth. And it is assets minus liabilities. It's the equity value, right? Now that said, if you've got a not-for-profit, you're going to lop off, typically speaking, that long-term investments. So the sale value, kind of that minimum estimated value of the firm is going to most likely be kind of the equity minus the long-term investments would give you this kind of adjusted book value. If you are a for-profit, this wouldn't be there to begin with, right? But if this wasn't there, then the equity values would be a lot lower too. Okay, so book value. It's kind of like the low estimate of what the organization be worth. And it's basically saying, hey, we'll pay you for the value of the stuff that you have minus whatever debt you have against that stuff. And that gives you the book value. A modification, so one of the problems with this though is, and we've talked about this a bunch, but just to refresh, when we value property, plant, and equipment, right? When we put it on the books initially, we put it on the books at the purchase price. So if I buy a building and that building is worth $100,000 when I buy it, it starts to depreciate, and it depreciates for tax purposes, over a 39-year schedule. So you're going to depreciate it. So if you're 20 years in, that $100,000 asset is now worth about half, about $50,000. But that said, maybe the real estate market has gone up in the 20 years that you bought it, right? So if you buy a house after 20 years, hopefully the market value is dramatically higher than it was when you bought it 20 years before. So all that said, very often the PPE value, right, that is on the books understates the actual value of the assets, okay? And so the actual assets on the books might be, so CMC has $94 million in assets on its books, net assets. So gross PPE minus accumulated depreciation gives them 94 million. And then they've got 35 million in other assets. So those might be other businesses that they have partnerships in or whatever. But let's just focus on PPE for a minute, just so I don't get make it any more complicated than it needs to be. The fact of the matter is that the PPE value is a historical purchase price, and it may not accurately reflect the market value of the PPE. So maybe the buildings that CMC owns are actually more valuable today than they were 10 or 20 or 30 years ago, even when they were built. And so therefore, the PPE might really be 200 million, right? Or 150 million, in which case the book value is actually understated, right? So if this was actually, say, 150, right, we would have to add more to our unrestricted assets to make it balance out. So let me see what that would be. Equals 398 minus 343. So we'd have to add 55,525 to our unrestricted assets. So let's do that real quick. 55,525. 55,525. Did something funny. Oh, need to do a plus sign there to make that work. Right. So now we're back to balance. And what is the actual book? And so if this is adjusted to the market value, right, as opposed to the historical value, then our book value would be 170 million. And even after we subtract off the long-term investments, we'd be offering to sell CMC for 71 million rather than 15 million, right? Which is a pretty significant difference. Okay, so you can have, so the historical price, right, because PPE is kept at the historical price. Let me undo this. The book value typically understates the actual value of the resources. And so when a business goes to sell itself, it'll start, the starting point for negotiations, if they're going to use an asset-based valuation, is going to say, okay, well, what do your financial statements, what does your balance sheet say that the book value of your firm is? And the book value of CMC would be 114, and then they would say, well, we're going to pull out that 99, and the purchaser would say, fine, I'll give you 114 minus 99, or 15. And then there would be a negotiation to say, well, that 94, it really understates how much the stuff we have is worth. The stuff we have is really worth 150. So they would go and they'd get into a negotiation, and then ultimately they might come to an agreement if they were using asset-based valuation, just focusing on the stuff the organization owns, as opposed to the value of the business in the sense of its profits as a profit-making machine, would be just the sorry, I lost my train of thought. So it would be the 15 million. So if you're ignoring, right, the profits that CMC actually makes, so we're focused just on the stuff. Okay, so you have so under asset-based valuation, you've kind of got two approaches. The first one is to say, what's the book value? And that's basically what's the equity in the firm, right? The second step is to say, the fair market value is the phrase that you want. The fair market value is not reflected, right? The fair market value of our assets is not reflected in our books. And so you've got to adjust our PPE value up to reflect the fair market value, okay? So it's still total assets minus total liabilities. It's just that we change the value of the assets to reflect fair market value, meaning how much could we sell the stuff that we're valuing for? Okay, so that's kind of the asset-based valuation approach. Any questions on that? All right, then I'm going to shift gears and start to talk about actually, I've got one more thing to show you. Sorry. We're going to move away from asset valuations now to focus on the value of the business as what we call a going concern, right? So a going concern just means this business is active. It's not like we shut CMC down and we're just like having a big yard sale to sell everything off. Like, hey, everybody want an MRI? Take an MRI home with you, you know? So, so that's kind of what we're talking about when we do a pure asset-based valuation. Now we're going to look at the business as a going concern, meaning how much is this thing worth when it throws off profit year after year after year? So we look at CMC here, and we say, all right, well, this is the income statement that I showed you a minute ago, and we say, well, how do we value this? Well, one technique is called the market multiple. And the market multiple typically focuses on the operations of the business. And it focuses on kind of how much cash does this business generate from its operations. And so when I'm emphasizing operations, what you should be thinking is, oh, we're going to take out the effect of how the business is financed, right? We're going to take out how much debt versus how much equity, and we're just going to focus on the business's operations. We're really interested in the operating income. Now, what we want to get at then is the earnings before interest, taxes, and depreciation and amortization, or EBITDA. You may hear that phrase. So this is before interest, taxes, depreciation, and amortization. And just to refresh, amortization is just like depreciation, except it's for intellectual property. So depreciation is applied to physical things like buildings and vehicles and equipment. Amortization is applied to non-tangible things like if you paid an architect $1 million to design a new building, that portion of the purchase is that $1 million is amortized, but there's no physical thing, right? You're basically paying for a service, and so that service, that $1 million, is amortized, and it works exactly the same as depreciation. Okay, so amortization and depreciation you kind of just think is one thing. The only difference is one applies to physical stuff that you can actually touch, and the other is it applies to expensive things that are non-tangible. There's a bunch of things, but we're not going to get into other details there. So interest, right? So that's this. They don't have any taxes. Depreciation, and they lump together depreciation and amortization on the same line. So how do we get that? Well, then we just go EBITDA is going to equal, we're going to just add back net income plus interest plus depreciation. So our EBITDA in this case is 25 million. And there is a second approach that you can use, which says that you would start, you would ignore non-operating gains. You could, in some cases, so it depends, who's doing the EBITDA calculation as to whether you would also knock off non-operating gains. I'm going to leave it there. I'm just going to take out interest and depreciation. Okay, so EBITDA. Again, I'm starting with net income, I'm subtracting interest, I'm subtracting depreciation. If this was a for-profit company, I would add back taxes, right? Because it's before interest and taxes. It's not a for-profit company, so I'm not doing that. Okay, so then I've got this EBITDA. So what do I do with it? Well, this market multiple approach says we're going to take some multiple, and the book uses 4.5 as its example. So I'll stick with that. This is super simple. You calculate EBITDA, and then you multiply it by the market multiple. And so, so in the previous example, we went from looking at it from a pure asset-based perspective. The firm would sell for 15 million. Then we said, well, you know, if we got the market value of the property, plant, and equipment, then it would really sell for more like something, I think we came up with like 79 million. Here's another variation. Now this market multiple approach doesn't focus on the stuff of the organization. It instead focuses on the earnings that the firm brings in. So how much cash is that firm bringing in? Well, and it ignores the financing portion, which is the interest. Okay. So where does 4.5 come from? Well, it's not arbitrary. I mean, I'm being a little arbitrary, but it is not an arbitrary number. That 4.5, so the EBITDA, of course, is a process, but the 4.5 is going to be kind of a consensus in the industry. So if, you know, there'll be some consensus in the industry that if you are selling a community hospital, the appropriate multiple would be, say, 4.5, 4.5 times EBITDA. If you are selling a physician practice, the multiple might be 5.7 times EBITDA. And if you're selling a billing company, the appropriate multiple might be 3.2 times EBITDA. I'm making those numbers up because I don't actually know them. But if you were working with a business broker, so there are people out there who make their living helping to broker transactions like this, right? So there are business brokers that help businesses sell themselves to first value the business and then to sell itself to another entity. So they would know, you know, and there would be, you know, whoever's buying the business would also be working with a business broker, and they would typically know, all right, 4.5 is about right, or they might, and then they might say, well, you know, the market in Southern New Hampshire is weaker or stronger or whatever, so we're not going to give you 4.5. That's kind of like a national average. We're going to give you, we think it's weaker, so we're going to give you 4.0 or 3.7. Right? And so then they'd get into a negotiation over what's the appropriate multiple to apply here. But the fact of the matter is there would be a multiple and we would use something like that. So that's kind of the first approach where we focus on the value of the business as a going concern. How are we doing on that so far? Anybody got a question? All right, not hearing any. I'm going to keep going because these now we've done the easy ones, and I want to do start doing some harder ones. All right, I'm going to move away from talking about CMC, and I'm going to be more abstract now. I'm just going to use some. I'm just going to use some numbers. So you've got this example in the email I sent you. So let's imagine now that we have a firm that is growing fairly fast, right? It's going from 50, and the numbers that we have here, so at the end of year one, it's going to throw off 50 million in, let's say it's millions, 50 million in free cash. What is free cash? free cash means that this is cash generated by the organization that investors could pull out of the organization and take as dividends. So that means it's going to be the net income. We're adding back depreciation because depreciation is not a cash expense. And then we're subtracting whatever amount of money needs to be retained by the organization to replace old equipment or to continue the organization's growth. So at the end of year one, this organization is able to throw off 50 million, and we'll cover that in a little more detail there in a second. For now, let's just focus on, we've got these cash flows, okay? And then we'll talk a little more about free cash in a second. So we've got these cash flows. In year one, it's going to throw off 50. In year two, it's going to throw off 65. In year three, it's going to throw off 85. So it went from 0 to 50, 50 to 65, so a gain of 15, 65 to 85, so a gain of 20, and then 85 to 110, which is a gain of 25, right? So big changes. And I'll just, so what's the change here? So it went from 50 to, divided by 50 minus 1. So we had a 30% gain here, a 31% gain here, and almost 30% gain again. So growing at a 30% rate, for the first 4 years, right? Let me just. Right, okay. Just want to check my calculations off to the side. So we're growing at a 30% rate from 1 to 2, 2 to 3, 3 to 4. All right, so if you remember way back in fall semester when we were doing management, one of the groups talked about the Greiner model, which talks about kind of organizations growing from startup to kind of slightly more mature organization where they start to have job descriptions and all this stuff, to a more professional entity, to progressively bigger and more professional. And the idea, let me switch my camera for a second. The idea here is time and free cash, right? In the beginning, it's going to grow really fast, right? And then it's going to kind of start to slope out and then have steady growth. So we're going to have some period of rapid growth, and then enter into a period of constant growth. Okay? This is a very simple idea of it. This is a two-stage growth model. So two-stage growth model. And if we were doing a more advanced class, we could talk about a three-stage growth model. We're not going to get into that. So through the first stage of growth, we had an average of 30% growth per year. Right? And then we get to the fourth year, and what we're going to see now is a leveling off of growth. And so the first 4 years, we had 30% growth year over year. After year 4, we're going to model the growth slowing down to 3% per year. And it's going to go on 3% per year forever. Right? So that's going to be our assumption, is we're going to go 3% per year forever after this. So the question is, how do we value that, right? So we had 50, and then 65, and then 85, and then 110, and then from here on out, it's going to grow at 3%. So if we would go back to our other screen, so let me just for a second put that in the way. So in year 5, the growth is going to be equal to 110 times 1.03. Right? And then in year 6, it's going to be 113 times 1.03. So let me, oops, that didn't work. There we go. So what you can see is steady growth, right, forever after. Get rid of. So whereas we had 30% growth from here to here, right, equals 110 minus, 110 divided by 85 minus 1, right? So we had, from here on out, okay, so we had rapid growth phase, that ends at year 4, and then after that, it goes to 3% growth forever. And this would just keep on going, right? So if we were to run this forever, it would just keep on going. At least that's how we're going to model it. So the question is, how do we decide how much this business is worth, right? So I'm going to delete this because at this point, this is all just going to grow, 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 grow. I don't have to delete, I guess. So if I'm trying to figure out how much this firm is worth, what I really want to know is what's the present value. So I'm going to use the present value of these cash flows, right? Well, this one's pretty clear. It's going to be, and by the way, my required rate of return on equity, and I'm going to use the required rate of return on equity here because I'm thinking about selling the business, right? And so I'm not using the corporate cost of capital because the corporate cost of capital incorporates the cost of debt. Here, I am purely focused on the return to the equity holders, and so the appropriate discount rate to use is the required rate of return on equity, as opposed to the corporate cost of capital is a blend of return to equity and return to debt. And I'm only going to use, in this case, the return to equity. So I'm looking for the required rate of return on equity, and I'm going to tell you that that's 10%. All right, so if I did the PV, right, well, year 1 would be 50 divided by 1.1 raised to the first power. And so that'd be 45. And then I go down here, right? And so each of these, that's how much each of these is worth. But what about going forward? Like I could keep doing that. I could just keep on going. Did I do that? Is that right? Yeah. And I could just keep on going out into infinity, and they're getting smaller. Why are they getting smaller? Well, because even though they're growing, the discount rate is larger than the growth rate, so they're going to keep on going down. The only way for them to keep on getting bigger is if the growth rate was bigger than the discount rate, which it's not. So you're going to expect to see this shrinking number. Now this would go on forever. So how would you can't do that. So we've got to figure out a way to value the future cash flows. So if we just delete that and we say, okay, so going forward, the value of the 5th year and beyond is going to be, it's going to have a 3% growth rate, right? We're going to discount it at 10%. It's going to look something like our DCF formula. So if we're looking 0, 1, 2, 3, 4, right? And we had 50, 65, 85, 110, and then it's just going to grow after this at 3%. how would we figure out how much years 5, 6, and on forever are equal to? Well, we have a formula for that, right? And that formula is EP0, right, is equal to D0 times 1 plus EG divided by RE minus EG. Except we're going to sub out this. We're going to call this something else. We'll call this the present value of the free cash flows is equal to the free cash flows times 1 plus EG divided by, and let's say free cash flows at time 0, divided by 1 plus EG times RRE minus EG. So it's the same formula. Okay, so this is a little bit of what we got into during the review session, and I was talking about, after tax equals before tax times 1 minus T. We use the same formulas a lot, and we apply them to different situations. So you have to kind of, the logic is the same. You have to be able to kind of plug in a different number here. So if we're looking to value, if we know this number is we're going to treat as free cash flow 0, because year 5 is going to be year 4 times 1 plus EG, right? Year 5, the year 5 cash flow, so free cash flow year 5 is equal to the free cash flow of year 4 times 1 plus 0.03. Running out of room. Right. Free cash flow 5 is equal to the free cash flow at time 4 times 1 plus 0.03, right? And then free cash flow 6 is equal to free cash flow 5 times 1.03. And free cash flow 7 is equal to free cash flow 6 times 1.03, and on forever. So basically, this formula allows us to, this is what we had done previously. We said, hey, we've got D0, right? If we imagine this was at time 0, we'd have D0, and then D1, ED1 would be this times 1 plus the growth rate, and then ED2 would be ED1 times 1 plus the growth rate, and so on and so forth. So we're, instead of calling it D1, we're going to call it FCF, right? Free cash flow. So we would take 110 times 1.03 in this case, divided by 10% minus 3%. Right? So we would have, and that would give us I need to do it here. 110 times 1.03, right? And then 0.1 minus 0.1 minus 0.03 is 0.07. So divided by 0.07 gives us 1618. Okay, so all these cash flows after year 4, right, all add back up to be worth $1,618, right? So you would buy all those cash flows would be worth $1,618.57. And they are worth that much at time 4. Okay, so the present value of the future cash flows going forward, 5, 6, and on, are actually worth 1618, but they are worth 1618 at time 4. In the same way, that if we said, if we had, right, 0, 1, 2, 3, 4, and on, right? If we said, well, the dividend at time 0 was $1, and the growth rate is 3%, we'd have 1.03, and then 1.06, and then, you know, and so forth, right? So if D0 is equal to 1 and EG was equal to 0.03, if we plugged all that in, we would say, okay, EP0 is equal to 1 times 1.03 divided by 0.1 minus 0.03, right? So we'd have 1.03 divided by 0.07 would give us a value of 1471. Okay, so I'm blending this together a little bit. This is ED1, right? This is ED2, and so on. This is D0. This gives us the value of these cash flows at time 0. Okay. So it's always, we're looking out into the future, and then we're bringing it back behind us to one period. So if we're looking at, all right, we've got some future value, it's going to be ED1, and going forward, how much is ED1, ED2, ED3, ED4, and all that worth today at time 0? So you get the value of all this stuff, and then you bring it back to time 0. So my point in showing you all that is I am calculating, get a clean sheet. One, 2, 3, 4, 5, right? 50, 65, 85, 110, right? And then there's all these free cash flows that happen after this point. So the next one was going to be 113, right? And it goes on and keeps growing. I calculated that all of these cash flows are worth 1618 and some change at time 4. Okay? So it's not at time 5. This is the, I guess that's what I'm hounding on here, is what I want you to remember is the first year of constant growth is kind of like your ED1. Right? So this is your first year of constant growth is like ED1, right? And then the next year of constant growth is like ED2. And we're going to go out from there. We're going to calculate the value of all that using our DCF formula. We're not going to call it EP0. We're going to call it the value of the free cash flows instead. Right? We're just going to kind of rejigger it. And then that's going to be brought back to the end of year 4. So it's worth 16, all these cash flows are worth 1618. These cash flows are worth whatever they're worth, right? So we get the present value of each of these cash flows. And then we also, so in year 4, we effectively get 110 plus 1618. So our total in year 4 is, what is that, 1728, right? So the future value at time 4 is really the 110 we actually get in time 4, plus the future value of all the constant growth that's worth 1618. Okay, so I'm going to shift back to Excel for a second. And I know this is confusing, so you're going to have to play with it a little bit. I'm going to shift back to Excel. If I can figure out how to shift, there we go. Okay. And delete that. Come on, cooperate. Okay. So this number 1618 that we just calculated is referred to as the terminal value. And the terminal value represents the value of all these cash flows and all the ones that are going to come in the future. So it's going to be equal to, like we said, the terminal, the last growing cash flow times 1.03 in this case, divided by the required rate of return on equity, which is 0.1, minus the growth rate, which is 0.03. And we get, it's not a percentile, let me just change that. 1618, it rounds up to 1619, okay? And I'm gonna do this, well, there's a couple ways to do this. So this is 75 is the value, is the present value of this cash flow. But what we really need to be discounting is not just this 110, but it's going to be this 110 plus the 1619. So I'm going to change this. Plus this, right? So now I am putting into the numerator the annual cash flow, the 110, plus the terminal value that represents all the rest of these payments, and I'm discounting it back. To the present. And so the total value, the present value of this firm's cash flows would be 1343.67. All right. So I know that's a little head spinning. So let's do another one because that's usually the best way to do stuff. Is to practice. Okay. So here we've got 5 cash flows in our kind of growth mode. This would be the DCF value. So, right, so we've got 5 years of growth, and then in year 6, it starts to grow at a constant 8%. So in year 6, it'll be equal to 1.08 times whatever you got in year 5, right? And then in year 7, it's going to equal whatever you got in year 6 times 1.08, right? So it's just going to grow. After year 5, it's just going to grow at a constant rate of 8%, okay? So what we need to do is calculate the terminal value. So if our terminal value is based on our 5th year cash flow, then it's going to equal our 5th year cash flow times 1.08 in this case, which is our growth rate that we have up above here, right, divided by the required rate of return on equity, which in this case is 18%, minus the growth rate, which is 8%. So we get 3704 is the value of all these cash flows going forward, growing at 8% per year. So then we can calculate the present value of the cash flows, right? And in this case, we're going to discount at 18%, it's a pretty significant number, right? 120 divided by 1.18 raised to the number of years. And we can do that down through year 5, but we need to modify it here because in year 5, we get the annual cash flow of 343, but we are also going to account for the terminal value. And so the discounted cash flow value of this firm would be $2,242,000. So the head spinner, in my as I was trying to learn this, I would get confused about where to put the terminal value. I always want to put the terminal value in the year with the first growth, but that's not correct. You actually have to bring it back one. So because the number you're using here is you're growing from the last rapid growth number, right? So this becomes the equivalent of your DC0, or D0 rather, not DC0, D0, right? And so it's kind of like having, what do I want to say? Well, yeah, it's like, it is like calculating EP0, but 4 years out, okay? So you could do that. Another approach with this would be, instead of doing the kind of manual approach that I did here and dividing, you could, let me just insert a column, total cash, and I'm just gonna, it's gonna be in this case equal to the sum of these two columns. And of course, the first several columns are just the same, right? And then it's like that. And then you could say, you can use the NPV formula, which again is really just the, it's not really the NPV, it's really the present value of future cash flows. You put in the rate, which is 10%, and then you select your cash flows, and you get the same answer, okay? So you could do that too. And we go over here and do the same thing. And it doesn't matter if it's 5, you know, if the growth, so this portion would be the rapid growth phase, and then after that is the constant growth phase, right? Here it's up to you. The rapid growth phase goes through year 4, the constant growth phase begins in year 5. Here, the rapid growth goes through year 6, and then constant growth begins in year 6. Rapid growth goes through year 5, constant growth begins in year 6. So we could do total cash again. And we just say, well, it's the sum, right, of these two columns. And then we can say, give me the NPV. In this case, the discount rate is 18%. And then my cash flows are here. And you get the same result, right? So as usual, I like to show it to you kind of the hard way first, and then show it to you using the formula. Okay, questions? I've got one more small variation that I want to show you that you need to see, and I've got about 15 minutes, but tell you what, if you don't have any questions, let's hold that, any thoughts, and let's jump to the next sheet that you've got, which is the free cash flow example. All right. Here I'm giving you a projection. So we're here in year 20, in 2020, right? This is us in the present. These are all projections because 2021 hasn't happened yet, right? So I've got an estimate of a firm that's growing fairly rapidly and then is going to level off in 2024. So going forward, 2025, 2026, right? This is 2025, 2026. This is going to be the end of my, this will be my rapid growth, right, during this period. Let's make it green for rapid growth. All right, or maybe it won't play. Make it green for rapid growth, right? And then going into the future, it's going to be constant growth. Constant growth, right? So after the rapid growth phase, we're going to shift to constant growth. All right. This should look familiar. We've just got a basic income statement, revenues, expenses, other expenses, depreciation, earnings before interest and taxes, interest expense, earnings before taxes. So this is a for-profit. So they're going to pay, they have earnings before taxes of 4 million. They're going to pay 1.6 million in taxes because they pay 40%. Right, this is just 40% of and you should have this so you can look at it with me. Then it gives you net profit. And then there's this number called estimated retentions. Okay, this is one learning point you've got to remember. What is estimated retentions? Estimated retentions is the amount of money, the amount of cash that's going to be retained. It's going to be retained earnings, and they have to do it, right? It's not an option. It is not free cash that could be distributed to the investors. It is cash that they need to keep in the business in order to get the rapid growth that we see up here. So in order to keep rapid growth going, as of, from 2020 to 2021, at the end of 2020, they have to keep $4 million in cash in order to continue to grow, right? And then in year 2021, they still need to keep $4 million in cash in order to grow. And then in year 2022, they need $7 million. In year 23, they need $9 million. And in year 24, they need $12 million. So they have an increasing need for additional cash. So what that means is, what we're going to try to estimate is how much cash could the investors pull out of the firm. So we've got to keep that estimated retentions in mind. Keep that estimated retentions number in mind. And we're going to do kind of what we've done in the past to talk about cash flows. We'll start with our net profit. We'll add back our depreciation because that's not a cash expense, right? And so this firm has 10.4 million in cash coming into it each year, right? 2.4 million in profits and 8 million in non-cash expenses added back. But that's not the end of the story, right? That's the amount of cash the business has, but that's not the amount of cash that the investors can pull out of the business. The amount of cash of the business that they can pull out of the business has to account for the estimated retentions. So we're going to subtract the estimated retentions to get the actual free cash. Okay. So there's actually 6.4 million that investors could pull out. Now we can just copy this formula across, and we get the free cash flow through the end of 2024. So at the end of 2024, they could potentially pull out 11.2 million in cash, acknowledging that they actually had, what would that be? Add back 20. They had 23.2 million in cash flow, but they have to keep 12 million of it. So 11.2 million could be pulled out. Now going forward, that amount is going to grow by 3%. So in 2025, we're going to assume that we have 11.2 times 1.03 in free cash, and then in 2026 it'll grow by 3% again, and on and on out, into forever. Okay, so what we want to do now is get the value of this kind of continuous cash flow going out into the future that's going to grow constantly at 3%. So it's the same formula as before, what we just did on the other page. It's going to be the free cash flow at time 0, in this case 2024, times 1.03, the growth rate, 1 plus the growth rate, divided by the required rate of return on equity, 18%, so 0.18, minus 0.03, the growth rate. That gives us 76.91. So then we say, so now we want to know what is the present value of the future cash flows. So we can do, again, we could insert another line. So one way to do this would be probably an easier way to do this would be to do the total cash flows. Total free cash flow. And that would be the sum of the terminal value plus the free cash flow. This will make it just a little bit easier. A little less complicated. So now we have, right? We've added, the only difference here is we've added the 76.9 to the 11.2. And so then we say, okay, what's the present value of those cash flows? Well, I've got an 18% discount rate, and then we select the cash flows, and we get a valuation of the business of 61.4 million. So that is free cash flow, the free cash flow approach. So we've done 4 methods of firm valuation today. Let me go quickly back over them. We started by looking at the book value of the firm, and we said, well, the book value is basically the equity. It is the assets minus the liabilities. Now, the problem with straight book value is that the PPE and other asset valuations are carried at historical value, not at their current market value, and so they're often understated. So instead of having, your book value is kind of a lower, the lowest possible value that you would have for a firm. Now, this not-for-profit hospital, this is CMC, right, has this big chunk of long-term investments. So depending on whether you're going to sell the firm with the investments or not, it changes the book value. And really what you're saying is, I'll sell you $99 million worth of investments. And an investor would say, I'll save my 99 million and, you keep the investments. I just want the firm, right? So you keep the investments, in which case it would lower the book value to the equity minus long-term investment. So this is common for not-for-profits. Then we said, well, if we adjust the PPE to reflect market value, then we would have an increased book value. So that is fair market value. So that's the phrase you need to remember, fair market value. We then moved on to look at market multiple approach, which instead of looking at the stuff the firm uses, we looked at the firm as a going concern, right? So in this case, we approached it taking just a single number, which is the EBITDA, right? Earnings before interest, taxes, depreciation, and amortization. Basically the operations, the amount of cash coming out of the firm, right, as a going concern. So we estimated real quick that CMC in 2015 would have had an EBITDA of 25.6 million. We then take a appropriate multiple, which is industry specific. If on the exam you would have to be given that multiple, right? So I would say the appropriate multiple is 4.5. You would then take the 4.5 and multiply it by the EBITDA, and that would give you a valuation of the firm based on its EBITDA, its single year cash flow. Now we did a couple of simple examples of free cash flow. I'll just jump straight to the answer here. So one of the things you're going to have to potentially do is I could give you down to EBIT, right? Kind of like I did on exam 1. I could give you like this section. And then I could tell you, they pay some amount of interest and they pay some amount of taxes, and you would have to figure out what their net profit was. I would have to tell you what the estimated retentions are. You're not going to have enough information to do that, so I will tell you what the estimated retentions are. So there'll be some, something that looks like this on the exam. You would then have to calculate what the free cash flow was, and the free cash flow is the net profit plus the depreciation minus the estimated retentions. You would calculate that for the rapid growth phase, and then you would calculate the value, the discounted value of the future cash flows, and come up with a terminal value that represents all the earnings in the constant growth period that come after the end of the rapid growth period. That would give you a value in the last year. You take you discount this back at the rate of return on equity, gives you the present value of the future cash flows. So those are the 4 methods of firm valuation, and that is my time for today. So thanks for playing. I hope you enjoyed the semester. I have set up, like I said, 2 review sessions. Your homework is due, I believe, Wednesday. Let's see. 2 review sessions. I think I got one on, what is it, Thursday, and then one on Saturday or Sunday, to go over more detail, because I know we did this fairly quickly. So I'll see you again at Econ. I know you're all, except for Rachel, you're all coming to Econ, so I'll see you there and chat with you a bit more. I will hang out now to answer questions. Let's stop the recording.